This is a download from the BBC. To find out more, visit bbc.co.uk/Radio 4.
Gilts, just an old-fashioned name for government bonds, and they're so called because they were safe or gilt-edged. But that safety means you get a low return, a very low return at the moment. The yields, that's the total amount you get over the 10 years of a bond, for example, of both interest payments and your money back at the end, was just 1.86%. That is the lowest in 300 years. That means if you were to buy a 10-year bond today, the return on your investment would probably be less than inflation. So you'll be getting poorer every day. So who would want to do that? Well, plenty of people, as it turns out. Investors are looking for somewhere safe to put their money while Greece threatens to crash under the euro. Some, David Miller, partner at Cheviot Asset Management, say that the low returns show that austerity is working, making the UK a safe haven. Others, Ian Williams, chairman of Charteris Treasury Portfolio Managers, argues that when interest rates return to normal, people will dump these government bonds, creating big losses. Good morning to you both. Ian, if I can start with you. If I hold this bond that I buy and I owe you, lend the government money for 10 years, I can't lose anything because I get my money back in the end. So it's not that risky.
Well, sorry. Well, you get 1.8%, but that's in nominal terms. If inflation is 3 or 4%, you're losing money every year in real terms, allowing for inflation. But
I at least in a troubled world, I know that I'm actually going to get my money back.
If you hold it to redemption, yes.
But if I want to sell it in the meantime, I might have to sell it. If interest rates go back to more normal rates, then everyone will pile out of it and go into something else, and I'll be left.
You would take a capital loss on your purchase, that's correct, yes.
David, do you say that this is a sign that austerity is working, that the UK is a safe haven? You can't really say that this is a good news story about the UK. It's a sign of a desperate economic situation. The only people buying them is because there's no alternative, and we know that the Bank of England, if all else fails, will buy them off us at the end.
Well, it is definitely a factor that this is not a good time for investors generally. There's a lack of economic growth in the Eurozone as a whole and in the UK and various parts of the world, and the gilt market does offer safety. The government's austerity plan may have its faults, but it has credibility for financial markets. On top of that, the UK controls its monetary policy through the MPC, and we have a floating exchange rate. So what we're seeing is a fairly powerful, attractive combination relative to what's going on in the Eurozone as a whole. And the UK, the gilt market, and these low yields, for the moment, the mismatch between buyers and sellers is there because the buyers are attracted by what the UK has to offer.
OK, lots of people out there who are struggling on fixed incomes, particularly pensioners, will say if you don't want to buy these, even though, as David says, they're rock solid, what would you be buying in order to give yourself a better return?
Well, you can buy equities, you can buy utility shares that yield 5 or 6%, and utility shares have very similar characteristics to index-linked gilts, but yield much more and actually give you a much greater positive cash flow and give you a cash flow that beats the rate of inflation.
David, the Bank of England owns 1/3 of all government debt, owns about £325 billion worth of it. Now, that's not a normal situation. As attractive as they may be, that's got to reverse itself at some point, hasn't it?
Well, they've got flexibility. In the UK, we have our own printing press, and that makes us different to the mainland Europe, those in the Eurozone. So it doesn't have to be reversed anytime soon. In fact, it could be further increased. So that is a positive factor, and these gilts could be held by the Bank of England to redemption. That gives them plenty of time to decide what policy is necessary to get the UK economy growing.
It's bad news for people on pensions, perhaps on fixed incomes, as we say. Quite good news if you want to borrow money, like the Chancellor might want to. And there's a lot of talk about him looking into a 100-year bond. So he would borrow money off us, which he would pay back in 100 years to lock in this long-term interest rate. Do you think people, Ian, would be interested in locking up their money for 100 years?
Well, it might appeal to some pension funds and life insurance companies who are trying to match assets against liabilities. But the potential capital loss between now and 100 years would be something horrendous if interest rates return to their average over the last 25, 30 years.
So the price of the actual bond would fall by what kind of level if you go from interest rates where they are here today to more normal levels?
If you put £100 into the new 100-year bond and interest rates were to return to their average over the last 25 years, the price of the bond would go from 100 to around about 35, 36.
Unless you held it to maturity in 100 years, even though we're all living longer, is a lot of maturity, David.
I think it is. We've got the example in the UK of the perpetual bonds like war loan. We know these prices are very volatile. It's a specialist market and not one that I would recommend.
Okay, thank you both. Ian Williams there.